Hello and welcome to Global Business Insights, where I bring insight on the main business stories, global markets, and what you need to know on latest macroeconomic data releases. US stocks slipped lower yesterday as investors braced themselves for earning reports from tech titans Alphabet and Microsoft. And as the results came in, tech stocks continued to slip in after hours. Microsoft and Google parent Alphabet outperformed earnings estimates. Still, the stock sank yesterday in after hours trading as analysts focus on the weak spots, however slight. But that is what tends to happen when equities are priced to near perfection. AMD also sank as its forecasts painted a tepid picture. In today's episode, we'll discuss these results, and we expect Amazon and Meta may be facing a similar fate when they report later in the week. Yesterday, we also saw the Bureau of Labor Statistics (JOLTS) survey showing 9 million job openings on the last business day of December, unexpectedly increasing from an upwardly revised 8.9 million in November. It's a slight increase from November, but the highest level in 3 months. Higher job openings increases pressures on wage growth as companies raise their work wages to attract new workers and retain the workforce. Also, it means less unemployment as companies also do not lay off staff for fear of not being able to find a replacement, keeping more than they need. And of course, it points to resilience in the economy, which reduces chances of imminent interest rate cuts from the Federal Reserve. Also yesterday, the IMF chief economist told the UK not to contemplate tax cuts and to make better use of any fiscal space it may have when Chancellor Jeremy Hunt announces the budget, perhaps the final budget ahead of elections later in the year. And of course, the spotlight is on Jerome Powell, boss of the US Fed, later in the day as the Federal Open Markets Committee concludes discussions on monetary policy. Also, UPS says it is cutting 12,000 jobs as it reported a disappointing final quarter and weak start to the year, and there is more. Ad-supported social media stocks were lower in late trading yesterday after Alphabet said its Q4 advertising growth came in slightly below market consensus. Overall earnings at $1.64 per share beat expected $1.59 per share. Revenues came in at $86.31 billion for the quarter, better than $85.33 billion that was expected. The report showed that Google Cloud at $9.19 billion beat $8.94 billion expected, while YouTube ads made $9.2 billion revenue compared to $9.21 billion expected, just slightly behind expectations. Sales climbed 13% from $76.05 billion a year earlier, but ad revenue still made a decent $65.52 billion, lower than the $65.94 billion expected. Alphabet earned revenues of $48.02 billion in its Google search and other segment, compared to estimates for $48.1 billion. That was, of course, just slightly above what they were able to do. Advertising revenue make up about 80% of Alphabet's top line. The narrative of embedding new generative AI tools in more key products requires considerable investment, partly financed by layoffs. But the slowdown in ad revenue is a red flag for Alphabet, though Google Cloud is coming up. The cash cow, that's the ad sector, needs to provide the cash for the more exotic future bets. After hours, Alphabet was down 5.73% yesterday. Chip maker AMD shares also down in after hours 6.49%. percent, though they beat revenue expectations in the last quarter, but they saw a modest decline in revenues for the current period. Reported revenues at $6.2 billion. That's a 10% increase year on year, beat $5.4 billion forecasted easily. But AMD warned of flat data center revenue and a decline in server and gaming segment sales. AMD is seen as the main competitor for NVIDIA with their new AI accelerator chips rolled out in December. According to the chief executive, Lisa Su, she said the demand for AI chips was accelerating during an incredibly exciting time as AI reshapes virtually every part of the computing market. Microsoft, after hours, down 0.33%. It slipped a little bit more than that just after it announced its quarterly revenue, beating very confidently. If you look at the biggest driver of sale, it's Azure cloud computing platform that rose 20% to $25.9 billion ahead of analyst expectations for $25.3 billion. With strong demand for cloud computing holding up and excitement about AI, total revenue climbed 18% to a record $62 billion, beating forecasts for $61.1 billion. Net income came in at $21.87 billion or $2.93 per share, increasing from $16.43 billion or $2.2 per share a year ago, and also well ahead of forecasts to see $2.77 per share in the quarter. Still, Microsoft shares were down almost 1% initially in after-hours trading. The intelligent cloud unit, including Azure, saw revenue of between $26 billion and $26.3 billion, up between 18% and 19%, and above the consensus of $25.9 billion. The other parts of the Microsoft ecosystem also did well. The productivity and business processes unit, including Office, productive software, LinkedIn, and Dynamics, was up 13% and delivered revenue of $19.25 billion, beating expectations. The more personal computing segment, which also includes Windows, Surface, Bing, and Xbox, was up 19% with $16.89 billion in revenue, slightly better than $16.79 billion expected. According to Satya Nadella, the chairman and CEO of Microsoft, said we've moved from talking about AI to applying AI at scale by infusing AI across every layer of our tech stack, unquote. Earlier this month, Microsoft opened up its Copilot for Microsoft 365 to all businesses, eliminating a prior requirement that customers needed to have 300 employees or more to sign up for the paid service. So there is a momentum building on the vast array of products and services. So why was Microsoft down in after hours? Traders may feel they have priced in more than they seem to be getting, and the first reaction is a sell-off to maximize profits in expectation that these shares could indeed fall. The bears also say that momentum is slowing, particularly in Office, which is seen increasingly as a mature product. Microsoft also lacks a noticeable presence in the important mobile market and is yet to be the top player in the key areas of growth like Azure. But Azure is a leading service that has been well adapted for hybrid office environments. And we can't also forget that Microsoft enjoys monopoly-like positions in Windows operating systems and its Microsoft Office, which keeps bringing the cash to help drive Azure growth. Both Microsoft and Alphabet warned that capital expenditure would be higher in 2024 as they make more significant investments in the technology infrastructure space underpinning generative artificial intelligence, which raises more questions on the economics of AI. I guess the big question remains, how long will Alphabet and Microsoft customers be in a buy AI now, figure it out if it works later mode? Like I said, Microsoft AI was down 0.33% in after hours Amazon Web Services is the market leader in cloud services with 32% market share, and they will report the results tomorrow. The International Monetary Fund chief economist Pierre-Olivier Gourinchas yesterday warned that the UK government should not introduce further tax cuts this year, even if it had some space to do so. Rather, the money should be spent on public services such as the NHS and social care and education, and also on targeted measures to boost growth, while of course preventing debt levels from increasing. In early March, British Finance Minister Jeremy Hunt announces perhaps the last budget before a general election is held. The opposition Labour Party are ahead in most polls, and Chancellor Hunt, after announcing limited cuts in his earlier statement, has perhaps saved the larger cuts for closer to the elections. The IMF sees just 0.6% growth for the UK this year, up slightly from an estimated 0.5% figure for 2023, better than a recession but barely above 1. Most people feel the UK already is in a recession. The IMF boss, in an interview yesterday, also said that despite a weak growth outlook for the year, the UK has seen positive news on inflation, which is forecast to average 2.8%. Reducing taxes enhances attractiveness for investors, frees capital for more investment and hiring, and can help boost economic growth and government revenues ultimately from taxes. But it's a more direct hit on funding for spending. We could have gone to public services, and of course, looking at the debt to GDP ratio, greater production in theory allows more debt to finance government. One has to compare tax rates and other business attractiveness factors, which today suggests that the UK is losing ground in the competition for global business. Rather than broad tax relief, the UK may consider incentivizing targeted high-growth sectors, but that may not be the populist response voters want. Another guidance bombshell came from UPS as they announced plans to cut 12,000 jobs this year in view of slowing demand and higher costs. UPS announced the job cuts in an earnings call yesterday. They have 495,000 staff worldwide, and they also say they saw a 9% drop in revenues in 2023 and are missing analyst revenue expectations in 2024. UPS also wants staff who still have jobs to return to the office 5 days a week this year. UPS is also looking at selling its Coyote truck brokerage business, which suffered a slump in sales from a downturn in the freight industry. And also in the UK, 4 years after the UK left the EU, new trade rules begin to apply from today. The implementation of the charges were delayed to allow businesses time to adjust the changes and potential disruption to supply chains. Further border checks will also be phased in over the next year, with physical checks starting from end of April. This means more documentation and potentially rising import costs for businesses, which of course feeds into inflation. Inflation pressures from Red Sea chaos and fears of stickiness at the last lap of bringing down inflation may now be compounded by new border bottlenecks. And the US Federal Reserve announces its interest rate decision today when the FOMC concludes its meeting, 1900 GMT. Power will avoid providing any market moving stares, I think, acknowledging, of course, the resilience in the US economy, record low unemployment, while inflation is also going down as expected. The Fed is in a more comfortable position and will not want to imperil that by a premature rate cut. Analysts also think they may gradually enter into a discussion on how long and at what pace they want to continue reducing the balance sheet. In the evening episode, we will bring you more on the Jerome Powell press conference. Well, that's it. This is Bodi Oshosami, and thank you for watching.